Hey, everybody. It's time for another episode of the Mortgage Minute. As usual, I'm your host, Mark Lima, your favorite real estate broker with the Lima Real Estate Group, and I'm here with my preferred lender, Justin from EPiQ Lending. Today's question is, what are closing costs and how do they apply in the mortgage process? Justin, go ahead.
Yeah, it's a great question, Mark, and I'm sure you get asked it all the time. I know I do by my buyers, whether they're first-time buyers or it's been a few years between their purchases. So let's keep it simple. So what are closing costs? So you have two buckets of closing costs. You have recurring and non-recurring. So your main closing costs are going to be your lender fees, escrow fees, and title company fees. Those are your recurring closing costs. The non-recurring ones is paying your homeowner's insurance for 1 year up front. If you're setting up an impound or escrow account to pay those taxes and insurance in the future, the money we collect up front to set an account for you, those are considered non-recurring closing costs, as well as prepaid interest, meaning the interest you pay on the day of closing through the end of that month. So very, very important. And then one thing I'll add to that is, a lot of buyers, they'll come to me and say, hey, Justin, Mark, I'm putting 20% down, 15% down, whatever it is. And they think that that's going to be their only out-of-pocket money. And as we go through the approval process, that's part of that process as well. It's not just approving them, but letting them know how the numbers work. So as far as out-of-pocket money, it's going to be your down payment plus your closing costs. So we're always make sure that we cover that with the client. So that way, when they find that perfect house, they know everything that they're expecting and there's no surprises. Last thing I'll touch on that is another follow-up question I always get is, hey, Justin, can we finance or include the closing costs into the loan? So yes, you can roll your closing costs into the loan. The way that works is basically you're going to walk away with a slightly higher interest rate. Every lender, every bank does it the same way. They're going to then give you what's called a lender credit towards your closing costs. So the only trick there is the market we're in with rates going up is the most important thing is when you're buying a house and financing it, you want to walk away with the lowest interest rate, especially with rates going up. You don't want to finance a higher rate over the life of the loan. So just some couple simple tips for our audience out there.
Awesome. Great information as usual. As always, if you have any more questions regarding closing costs and how they apply to the mortgage process, or any other mortgage related questions, feel free to reach out to Justin. His contact information is on the screen. And if you have any questions with real estate related stuff, you always know where to find me. Until next week, have a great day and we'll see you next time.